Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome. So we're releasing our CIO Office 2023 Outlook entitled Playing It Safe. Today I have with me my two regional CIOs, Manpreet Gill in Dubai and Raymond Cheng in Hong Kong, and we will go over the main conclusions from the report. Before we get started, I just wanted to invite you to our 2023 Global Market Outlook event. As well as covering our CIO Office views and taking your questions, I will also have a fireside chat with Mark Carney, who has served as Governor of the Bank of Canada and the Bank of England and is now Vice Chairman and Head of Impact Investing at Brookfield Asset Management. If you'd like to join us, please go to www.sc.com/GMO to register. So with that out of the way, let's get into the meat of what we want to talk about today. So Manpreet, let's start with, obviously it's been a very challenging year for 2022, but as we look forward to 2023, we're clearly getting mixed economic signals. So how do you assess the state of the global economy heading into next year, and how should investors position themselves?
Well, hi, Steve. That's absolutely right. I think if you take an economic lens, we do expect the economic outlook to continue to be quite challenging as we go into 2023. And to summarize the key points of that, we do expect the US and Europe to enter an economic recession as the rate hikes we've seen so far start to bite. But China may be an exception there because unlike the US and Europe, we're seeing policy trying to support rather than restrict growth. And we are hopefully seeing an improvement in mobility. Now, what that means for interest rates is that we do expect Fed rates to peak in the first half of 2023 as inflation also starts to slow on the back of those rate hikes. Now, for financial market investors, though, I think it's important to differentiate the market and the economic outlook because, think about bond markets, for example, they actually tend to do quite well from the point where Fed rates start to peak. And even equities, which they do tend to bottom later in economic recession, but they usually do bottom well before the end of the economic recession. So when you start pulling all that together for investors, for 2023, we believe the best way to manage foundation allocations is through what we're calling a SAFE strategy, SAFE. So I'm sure we discussed the whole acronym, but I just wanted to highlight the S in SAFE, which stands for Secure Your Yield. As we described, we do think 2023, promises to be a great year for bonds. Yields across many bond asset classes at the highest they've been in at least a decade. And as we discussed, high quality bonds tend to perform well, usually after around when Fed rates start to peak. That's why, two of our key overweights include government and high quality corporate bonds. And we're even starting to consider extending bond maturity profiles. But this logic applies to multi-asset income strategies as well, which is also one of our top picks. Yields have more than doubled in some components. And we believe today we have a great window to lock in what we see as pretty attractive yield levels.
Okay, so maybe I know that one of the things that we're focused on is Asia dollar denominated bonds. And we've also, from an equity perspective, we've seen a very sharp sell-off in Asia ex-Japan equities. So Raymond, what's your view? Can this trend continue? And what is your outlook for Asian equities?
Yes, Steve. I think you touch upon two investment areas that present long-term value. That's the A within our safe investment focus for the year of 2023. Basically, we think that these two investment opportunities are now presenting very good long-term appeal. Let me start off with Asia US dollar denominated bonds. 85% of these bonds are actually issued by investment grade rated issuers. So what that means is the credit quality is actually relatively high, while default risk is quite manageable. But meanwhile, of course, there's a possibility pockets within the other 15% that are high yield bonds could see slightly higher default risk. But that could be compensated by much higher average bond yield of this bond asset class that is standing at around 7%. So on balance, we think that this particular bond class presents a very interesting proposition from here on. In general, as Manpreet pointed out, we actually prefer high quality bond investing to equity investing for the year of 2023. But within equities, geographically speaking, we prefer Asia ex Japan. Now, you may ask why we are cautious on developed market equities. In fact, our base case scenario assumes a recession in the US and Europe within the next 12 months. So, if history is any guide, it's premature to call for an overweight in developed market equities at this juncture. So if we zero in onto Asia ex Japan equities, I wanted to point out that China accounts for 1/3 of this segment. And if we take a look at China equities, as you well pointed out, Steve, China has had a good rally since October for a little while. But if we take a look at the year-to-date performance, China still notably underperformed the rest of the world, down almost around 25% year-to-date. There are a couple of reasons why we think China could see some sustained outperformance in the next 12 months. First off, I think China equity valuation is very attractive at the moment, sitting at close to, if not at, a crisis level. So basically, it implies that most, if not all, of the negatives have already been priced in. The next thing is that China policy is clearly pivoting towards easing at the moment. We are seeing a stabilization of the property market, actually a turn of the COVID policy by relaxing a lot of the restrictive practices at the moment. And on top of it, we are also seeing a revitalization of economic growth by stimulating domestic consumption. So all this points to potential earnings upside. And Asia ex Japan corporate earnings would tend to benefit most from a gradual return to normal by the Chinese economy. And what's more, as we assume the dollar to weaken in the next 6 to 12 months' time, as the Fed starts to pause the rate hike process, right? We think that this is historically proven to be conducive to emerging market, including Asia ex Japan equities. So overall, we actually like Asia ex Japan equities, despite underweight positioning in equities overall. And we think that Asia ex Japan equities provide diversification benefits because India, as the second largest market segment, provides a good hedge against any unexpected volatility in China equities as well.
Okay, thanks, Raymond. Thanks, Manpreet. I guess the S and A are really about sort of opportunities we see, so securing your yield and allocating to long-term areas of value, particularly those Asian asset classes of Asian dollar bonds and Asian equities. I guess the F and the E is more sort of risk management. So I guess, we are looking for a recession next year. It is going to be a difficult environment still for investors to navigate, even if we believe it's going to be a lot better than this year, of course. So maybe how do you advise clients to prepare for these surprises?
Well, Steve, I guess one way to prepare for it is through the F in SAFE, as you described, right? It's an F is for fortifying against further surprises, and that really has three components in there, right? Because if you go through an economic recession, we often do get unexpected, downside shocks, even if they're temporary. Now, one route through which investors can sort of try and sort of put a shock absorber in place is high quality government bonds. So we already discussed why we think they're an attractive opportunity today because of the yields. But normally when one gets a negative downside shock, usually bond yields go down, or in other words, bond prices go up. So not only do you get a yield, but that can be one way to sort of build in a shock absorber. A second route could still be a gold. It's an asset class we have a neutral view on, and we believe a neutral allocation makes sense. But gold is of course well known as sort of a short-term risk hedge. We've seen that play out in geopolitical risk, for example. But actually, as we go through later in the year, perhaps not Q1, but through the full year basis, if inflation does come down, and the Fed does indeed consider cutting rates, that lowers real or net of yield bond yields, and that can be quite a tailwind for gold, which of course doesn't have a yield. The third route, of course, is cash, and it's another asset class which we have a neutral view on relative to other major asset classes. Not obviously a top-ranking asset class, but with yields now above 4% from a Fed policy rate perspective, at least, that of course can be a third route through which to fortify against the possibility of any surprises as we go through a recession.
Okay, so Raymond, we've covered SAF. What does it E stand for?
Of course, I should take care of the last alphabet of our strategy. E stands for expanding beyond traditional asset classes. Admittedly, this is something that we have been doing over the past decade. We as a team have incorporated alternative strategies into our asset allocation recommendation for over 10 years' time. So this is not something new, but the year of 2022 has proven adding alternative strategies into our portfolio does provide enormous benefit. And the reason being, primary markets actually provide uncorrelated returns to the listed market performance. So in general, right, let's take a look at liquid alternative strategies. They are quite stable and less volatile compared with listed equities to start off. And also macro and CTA strategies tend to outperform in recessionary times. And what's more, private investments also add diversification benefits to the overall portfolio and help safeguard against any inflation and geopolitical risks. Using infrastructure as an example, infrastructure assets, many of which in general are linked to inflation. So the cash flows generated from infrastructure assets are inflation index. In other words, protecting our investment in infrastructure against any loss of purchasing power. And meanwhile, a lot of infrastructure investments these days are geared towards deglobalization, energy security, and also climate change. So this helps our asset exposures get more relevant against the evolving macro environment. And last but not least, private credits are also very interesting at this juncture as we advocate an income preference at this time in terms of our investment strategy. And we prefer private credits to leverage loans and also high yield bonds.
Okay, well, thanks Raymond and Manpreet for sharing the key highlights of our 2023 outlook. That's all we have time for today. Thank you all for joining us as well. As mentioned at the start, please sign up for our Global Market Outlook event at www.sc.com/GMO. In the meantime, if you want to find out more about our views, please listen in to our podcast mini-series next week on our Standard Chartered Money Insights podcast channel, or go to Standard Chartered Wealth Insights on either LinkedIn or Facebook. I look forward to speaking with you more next week. In the meantime, please keep well and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.